The ripple effect, tax incentives, and small businesses. Introduction. Welcome to the ripple effect, where we explore how policies impact our economy beyond the surface level. Today, we delve into the realm of tax incentives, examining why governments deploy tax credits and deductions to motivate business actions, ranging from hiring practices to entrepreneurial ventures. Why tax incentives? Governments often use tax incentives as tools to encourage businesses to engage in activities that have broader societal benefits, such as hiring from underrepresented groups or encouraging new startups. For instance, the Work Opportunity Tax Credit is aimed at promoting the employment of individuals from certain groups who have consistently faced significant barriers to employment. On the entrepreneurial front, increasing the tax credit for starting a new business is seen as a way to stimulate economic growth and job creation. These incentives are designed not just to boost economic activity, but to steer it in directions that align with public policy goals, such as reducing unemployment or fostering a more innovative economy. First-order effects, immediate impact. Tax incentives can have a significant impact on the financial health of businesses. Tax credits such as the Work Opportunity Tax Credit, WOTC, can reduce the costs of hiring and training employees from targeted groups, potentially enhancing workforce diversity and inclusivity. Moreover, increasing tax credits for new businesses might lead to a surge in startups, which could boost innovation and competition. On a personal note, instead of promoting the creation of more startups, which may not have sustainable business models but are attracted by tax incentives, it would be more beneficial to direct these incentives toward supporting existing businesses. Businesses that employ workers and who are facing external pressures not of their own doing, such as inflation. There are already numerous motivations for starting a business. Are additional incentives really necessary? Within the context of first-order effects, let's consider Handy Help Co., a startup handyman service aimed at assisting seniors who wish to age in place with household maintenance tasks. Initially, Handy Help might benefit from using programs like the Work Opportunity Tax Credit, WOTC, which could reduce payroll expenses by hiring qualified employees from groups facing significant employment barriers, such as veterans, ex-felons, individuals receiving certain types of public assistance, and others. Furthermore, as a new business, Handy Help might boost its initial investment in equipping its teams, provided it secures short-term capital from a lender or investor. This approach is based on the understanding that the upfront expenditures would be offset by the additional profits from the tax credit received after filing taxes at the end of the first year. Second-order effects, economic and competitive dynamics. The broader deployment of tax incentives can lead to increased business activities, but it also raises questions about market distortions. For example, while tax credits for hiring may help reduce unemployment, they may also encourage companies to prioritize tax savings over finding the most qualified candidates for a job that can improve their chances of continued success. Moreover, the proposal to increase tax credits for starting a new business, although seemingly advantageous, could inadvertently encourage startups to overspend in their initial year to maximize the tax benefit. In the case of Handy Help Co., while the company can benefit from initial tax savings from WOTC, there's a risk that the focus might shift from hiring the most skilled workers to prioritizing those who qualify for the credit, potentially affecting service quality. Furthermore, increasing tax credits for new businesses could lead Handy Help Co. to face heightened competition as more startups enter the market, possibly inflating costs and creating a bubble of businesses more focused on exploiting tax credits than on sustainable growth. Third-order effects, cultural and structural shifts. Over time, tax incentives can significantly alter industry norms and expectations. For instance, the Work Opportunity Tax Credit, WOTC, may shift hiring practices towards meeting diversity goals rather than focusing on overall employee performance, potentially resulting in a workforce that is diverse but not necessarily performance optimized. Additionally, increased tax credits for new businesses could foster a culture of speculative ventures primarily aimed at maximizing initial tax benefits rather than establishing sustainable operations. Additionally, increasing the tax credits for starting a new business, although seemingly advantageous, could inadvertently encourage Handy Help to overspend in its initial year to maximize the tax benefit. For Handy Help Co., these cultural shifts in the industry could make it difficult to navigate a business environment with widely varying competition quality. Many new businesses may be driven more by financial incentives than by real market demand. This could flood the market, making it challenging for genuinely efficient and customer-focused companies like Handy Help Co. to stand out. Additionally, if new businesses overspend during their startup phase to maximize tax credits based on unsustainable business models, it could lead to higher rates of credit default. This not only jeopardizes the founder's credit, but could also make lenders more cautious. Conclusion: tax incentives, while initially appealing for their immediate benefits, often lead to unintended economic distortions. A careful analysis of their second and third-order effects reveals that these policies can fundamentally alter business dynamics and market landscapes. Therefore, they should be used judiciously and with a comprehensive understanding of their potential impacts, and not strictly to garner votes or curry favor with specific voting blocs. Thanks for tuning in to The Ripple Effect. Join us next time as we explore the far-reaching consequences of another key policy.